Today we're going to be talking about property investing for beginners and specifically buy-to-lets. We'll be talking about whether buy-to-lets are still profitable and delving into some of the drawbacks such as tax and how you might overcome these problems. Hello, welcome back to our channel and podcast. My name is Gemma and here at WIS we talk about all things relating to money, mortgages and positive money mindset. So if that interests you, then be sure to subscribe to our channel and hit the thumbs up. It really helps with our YouTube algorithm and means that you won't miss out on any of our videos. On today's episode of Let's Talk Money and Mortgages, we have Iftikhar co-hosting again. So if you didn't already know, Iftikhar is a trained accountant and mortgage advisor who has been in the industry for over 10 years. He is also one of the founding directors of WIS Group and he is also a property investor enthusiast. So it's an absolute pleasure to have him back on the show. Iftikhar, thanks again for joining us today.
Thank you. It's a pleasure being here, Gemma.
So Ifti, a lot of people are wondering, how old were you when you first bought your first property?
Good question. I think I was about 28. I was born in Sri Lanka. I came to UK when I was 27. So kind of 2 years down the line, 28, 29. I think that's the first time I bought my property.
Yeah, that's pretty good going. So Ifti, what is a buy-to-let?
A buy-to-let is an investment property. If you buy a property to let out, that's called a buy-to-let property. It's not legal for you or one of your family members to live in that property. It's mainly for the purpose of letting out. So that's called a buy-to-let property.
Now that was my next question because I know a lot of people ask that. You know, what about if I rent it to my family or my friends? So it's just that's not okay, is it?
No, not to the family. Friends, yes. If it's like an arm's length transaction, that should be fine. But not family. It's strictly not family. Yeah.
The next thing that I wanted to know is, are buy-to-lets still profitable in 2021?
I think so. I think you're mainly referring to Section 24. That's a new change that is in full force from this tax year because there was a step method, but they use. If you go back a few years, if you take an example, if somebody made 10,000 income and if they had, say, £3,000 as interest, assuming there's no expenses, your profit is 7,000. So if you're a high taxpayer, you paid 40% tax, which is 2,800. Now, what's changed this year is that £10,000 is taxed at 40% to start off with, but on the interest, the government gives you a 20% rebate kind of thing, right? 40% of 10,000 is 4,000. So on the 3,000, they give you to deduct something like £600. So 4,000 minus 600 is 3,400. So previously you paid tax of 2,800, but now you pay tax of 3,400.
Okay, well, what do successful property investors do to get around this Section 24 then?
With most of our clients, and I mean, I work quite closely with some other property investors, it hasn't quite deterred them from doing property investments, right? So basically with property investments, there's two types of returns. One is year on year, you will make something called ROI, your return on investment. So that number for certain quarters of the market who's affected by Section 24 may have a problem. But for the others who've found methods which you asked just now, some people invest through companies, some people has sort of diversified within the property sector itself. They do things like rent to rent, or which is, you're renting out a property to rent out, or they take properties on rent and they sort of give it out for service sort of accommodation. So they do certain different things, and especially with COVID, what's happened is a lot of people are doing things like staycations. So furnished property lets, right? So those have become very popular as well. So they are sort of diversified into different areas to get around this because furnished property lets has certain tax concessions which normal buy-to-lets don't have. And a very popular one is investing through companies, right? So that's become very popular as well. So that's happening quite a lot, right? But the way I sort of look at it is, looking at some of these strategies, there is two types of sort of returns that people get. One is the short-term ROI, year on year what you make, and also the capital gains, right? So you got to look at both, right? So yes, your short-term return on investments may have reduced, but your sort of long-term, capital gains, I think still kind of remains the same because there's no difference in tax on those, right? So therefore, people do still make money, right?
And just for those people who don't know what capital gains tax is or how much, could you just give us like a little brief overview?
So capital gains tax is something where you do when you kind of come out of the property market, right? So if you sell a property, so if somebody sells a property, let's say they bought it for 100,000 and they sold it for 200,000. So on that you made a gain of 100,000. So that will be taxed. You have personal allowances that you can deduct, but also if you have lived in the property, there are some concessions. There are concessions for periods that you've let out the property. So there are a lot of concessions in between as well. But the bottom line is capital gains is the difference between the sale price and the difference between the purchase price, right?
So is that kind of why some people have like a property portfolio, because they don't want to sell the properties because then they have to pay extra tax on them?
I see from some of our clients what they do is when they think they want to kind of retire, they sort of sell off property by property because every year you have this allowance, right? Capital gains allowance. So they try to make use of that.
And how does tax work then when purchasing a rental property?
Assuming it's bought on your personal name, you have this year-on-year tax that you pay, right? So your income minus your expenses and whatever element of interest you're allowed to deduct, the difference between those is the profit you make. On the profit, you pay tax depending on what tax bracket you fall into. So that is your ongoing tax. If you decide to sell properties, there is capital gains tax. Taking it one more step further, if you die, your estate may have to pay inheritance tax.
I've heard a few people talk about the concept of BMV. Do you want to give us a little insight to what that is?
That's buying property below market value. So that's a strategy that a lot of people use to sort of make gains, right? So what this really means is you buy property below the market value. So if a property is advertised for say 100,000, assume 100,000 is the right price, right? Through negotiation, if you buy it for, but let's say 80,000.
Okay.
So that 20,000 discount that you get is actually a gain for you because you bought it below market value by 20,000, right? People do a lot of fancy things afterwards, right? So they buy below market value, they add a little bit more value, and the property value actually goes up. A real property investor will always concentrate on trying to get property below the market value, right? So that's why this concept is quite important.
So the art of negotiation comes in there then, I suppose.
Definitely, yeah.
Okay, Iftis, there's a trend at the moment talking about OPM, buying a property with other people's money. What do you think about that?
It can be a little complex, right? Because it depends on what kind of arrangement you have, right? The simplest form is you can take a loan from the bank and you can use that to buy a property, or you can, use your parents or family members' money to buy property. Those are more common. Limited liability structures are becoming very common as well, and with that people do things like joint ventures, right? So they get together with a friend who doesn't get involved in the real transaction, but they're like an investor. So if you are sort of buying below market value, this is very connected. Let's go back to the same example I used, right? 100,000 property, you bought it at 80,000, right? So what you need is on the 80,000, you need a mortgage. Usually you need a 25% because it's a buy-to-let, which means you need 20,000 pounds, right? So that money you either use from your joint venture partner or your parents fund you, right? So you take that, you buy the property, and what you do is try to make the property more worth than what it is. Let's say you spend 15,000 pounds on the house, right? With that 15, you may have added another, say 25,000 to the property, right? So let's say the property value is now 120 after you doing the extra work, right? Now you go back to the bank and say, look, my property is worth 120. Can I do a remortgage on this? So the bank says, okay, fine. 25% deposit I need from you. So 120 is 30,000, right? So which means the bank is now willing to give you a mortgage of 90,000. But before, your mortgage was only 60,000. There's a difference of 30,000, right? So now you take that money out of the property and you go and pay off your parents or your joint venture partner, whoever it is, you pay off that money because you only borrowed, 20,000 from them, right? So you pay them off. Suddenly you end up with a house with you having not spent any money, right? So that's what this concept means, right? So it's a nice concept if you can make it work, right? It has worked very well where people have bought properties in high demand areas, right? Because if you can get a property in a high demand area and you pay below market value, there's a very good chance that you can do this very successfully. Some of the strategies our clients use is very unique. One of the things that really impressed me is something called leafletting. I'm not sure whether you heard of the concept. Yeah, they select a street, right? So where they want to buy a property and they go and drop notes saying, look, we are looking for houses. If you're interested, please talk to us, right? That kind of cuts off the middleman, right? So there's no estate agent involved because there's estate agent fees and all that otherwise. So they managed to negotiate the price down. A lot of investors work closely with estate agents anyway. So sometimes on some of these properties, estate agents tell them that there's a new property before it's been advertised on Zoopla or Rightmove or whatever it is, right? So it's a good concept if you can implement it, right?
Yeah, no, it sounds like that. And I was actually going to say, how does buying a property in the right area make a difference to your investment?
Yeah, it does make a big difference, right? What they say is location, location, location. There was a TV show, right, which was that, right? I think I strongly believe in that. I'll just take one example of one of my clients. That's right. He invests mainly in an area which is popular with a particular grammar school, right? That's his key area that he invests. What he tells me is that grammar school, every year there's a demand and people from other boroughs can apply for that grammar school. So, somebody might be living in Reading and they can apply in that area. So what happens is when the child gets this place in school, the parents kind of move to that area and immediately they look for a property to rent, right? And at the same time, he follows this buying below market value sort of concept. There's always a demand for that as well. So at any given time, there are these parents who are willing to buy those properties, right? So for me, those are like hot areas, right? So because you might get better gains in some of those areas.
Yeah, that's such a good idea. Thanks for sharing that one, FD. The last question I have is, should I incorporate when purchasing an investment property?
Again, there's no one-for-all solution here, right? Because obviously with Section 24, which we spoke about earlier, incorporating is one of the alternatives you have, right? You need to speak to an advisor on this before you embark on this one, because like I said, it's not a solution for everybody. So if you're a basic taxpayer and maybe you're thinking of just one property as maybe your retirement fund or whatever it is, it may not be the best idea to do this, right? Or if let's say you're married and your spouse is not working, right? It may not be the best idea. But if you're a serious property landlord and you're thinking of building portfolios, this might be a solution for you, because otherwise you're going to get hit by Section 24, right? Yes, you may end up paying a little extra interest because buy-to-let through businesses, generally the interest is a little high. But remember, you are saving that big chunk on tax, right? So if you are saving more on tax as opposed to the interest you pay, it's not a bad idea to do that, right? And also there is kind of restrictions from a bank with portfolio landlords. If somebody owns 3 or 4 properties, generally banks classify you as portfolio landlords, which means generally the underwriting is very strict with the banks. And also what happens is they sometimes get interest rates which are higher than a normal landlord. So therefore, you are kind of hit both ways there, right? One of the leading banks back in 2019, they said that 2/3 of landlords are considering that they will buy properties in future using a company, right? So this concept is becoming very popular. I can see it looking at our clients as well, because a lot of people seem to be asking this question. Get some advice on this before you embark on this one. We have some workings which says, should I incorporate, right? So if you contact one of our accounting staff or somebody from even our mortgage team, they should be able to share this with you, because like I said, it doesn't work for everybody, right? So there is some workings we can put together and see whether it's worthwhile you doing it. So yeah.
And I have a few questions that have been sort of sent in, so I just wanted to kind of ask those in our question time of the podcast. A lot of people are kind of scared at the moment, with COVID. Is the market going to crash? Is the market going to crash? And there's this idea that, don't wait to buy property and wait. Is that
Yeah.
something that you would agree with?
With these things, there's no crystal ball, right? There's no right solution. I bought a property in 2008, right? And my boss, he looked at me and he said, "You're probably the only one who's buying a property at this time, right?" I was like, no. I said, "Look, I can't live in this small house. I need a bigger house. So obviously I've got to do this, right?" So the first couple of years was, pretty bad, right? Because the property price did not go up, right? But then the next few years, it just skyrocketed, right? Over the period between then and now, the property value is more than doubled, right? So
Wow.
yes, so there is sort of some truth into what you're saying, but it all depends on your attitude towards the risk, right?
And when you're talking to clients, do you generally recommend getting an interest-only mortgage or a capital and interest mortgage?
Generally, the recommendation is always do a repayment mortgage, because with a repayment mortgage, let's say it's a 25-year term. At the end of the 25-year term, the house is yours, right? But if you get it on an interest only, you got to pay the capital or you got to sell the property, right? So therefore, the recommendation is generally to do a repayment mortgage. So what we find is interest-only mortgages are the most popular one, because what happens is most of the investors that I work with, like our clients, our accounting clients, they save up. So over a period of time, then they'll go back to the bank. If the prices of the houses increase, they will remortgage. They will take the money that they've collected together, they will buy another property. So that has been one of the strategies that most of the investors have been using, and they have been using that very successfully, right? But generally, as sort of advisors, we advise people to do a repayment, but a lot of people prefer interest-only mortgages because there is a lot of benefits in that one as well. Yeah.
Yeah. Well, thank you, Ifti, for that great advice. I just wanted
Okay.
to put a reminder out there that these points may or may not be applicable to all borrowers. So please do talk to an advisor if you're unsure about whether these suggestions are suitable for you. And if you don't have a broker, I will leave our WRS contact details below, as we are always happy to help. Another little reminder that as a mortgage is secured against your home, it could always be repossessed if you do not keep up with the mortgage repayments. So thank you again for joining us today. We'll be back again next week with another episode of Let's Talk Money and Mortgages. Have a great day, stay safe, and we'll see you again soon.